I don't think we can talk about any market today without the infamous two-letter word, AI. The need for infrastructure is leading to a lot of discussion around data centers and the builds needed to support the massive amount of innovation taking place. Would love to get each of your takes on what this means for credit markets as a source of financing all of that infrastructure.
So on the public side, what we've observed is that data centers have been sort of a niche product from the standpoint of the asset-backed markets have been issuing data center financing going back several years now. I think maybe our first deal was in 2019, say. And it's something that as a public investor, I've definitely, as it was sort of building, it's something that we have found attractive. The bonds are secured by the real estate asset, and in many cases, if you go back in time, we felt really good about the quality of the tenants and the leases that were in place. But if you fast forward to today, and having the chance to work with Ravi so closely and his team and understand their views on the replacement value around these assets, the equation has really changed for us in terms of how we're thinking about investing in these public assets. And it has changed, one, based on the view of the replacement value of the asset, but then also, two, just the CapEx spend and the amount of financing that needs to occur between today and, say, 2030. The estimates are anywhere from $1.5 trillion from Morgan Stanley to, say, $5 or $6 trillion from JP Morgan in terms of the amount of money that needs to be raised to finance data centers. So the decision as to how we were thinking about going into the investment, say back in 2019, 2020, is very different than how we're thinking about it today. And as public investors, we can access exposure to data centers through many different avenues. It can be through the asset-backed markets, the commercial mortgage-backed securities markets, the high-yield markets, exactly, or companies issuing either secured or unsecured debt.
As credit investors, we have to make sure we don't have FOMO here with data centers. One thing to consider with real estate is that there's no lease in perpetuity. So when I think about data centers, I think about the terminal value as collateral for my asset. So if you have a data center with XYZ AA rated credit tenant, you have similar AA rated tenants on industrial assets. And I just find that the pressure and the interest on data centers relative to some other relatively important sectors in real estate is not as compelling today.
Yeah, I would just add, I think from the investment grade private credit side, similar to what Ravi's saying, I think there are different opportunities. So rather than having that FOMO and there's one certain kind of a deal to look at, I think especially for our market, there's different ways that we could participate. For example, we've seen utilities looking to either strengthen transmission or make investments in additional power generating capacity. So there are those types of deals that are a little bit more adjacent, but not necessarily data center, that could be interesting for us. But I do also think it's important to remember that, especially in private markets, all of these transactions are different. All of the terms, the documents are really tailored to what, for example, Ravi's talking about the leases. So the details really do matter, and the underwriting and the structure of the transaction to make sure it fits and it makes that type of risk acceptable and that risk reward is in balance and appropriate for the situations. I do think that that's one place where the private markets are particularly well placed because it is a negotiated market. It really isn't kind of take it or leave it. If you want to be in the deal, this is what it kind of looks like type of thing. So I do think we have the opportunity to be a little bit more selective, have a hand in what that transaction actually ends up looking like in terms of negotiating those terms, and really just selecting those deals that make the best sense for the clients.
So there's perhaps a data center loan backed by a AA, AAA credit that amortized your loan within the term of the lease might be safe and interesting.
Yeah, so for example, for us as investment grade, longer term buy and hold, Technology risk is not something that we're looking to take a risk on. Also, because we are looking to invest in something that has incremental relative value versus a public, we're looking for that appropriate amount of spread. That illiquidity spread needs to compensate us for the complication, the structure that we have, and then also that illiquidity. But to your point, it may well be much more interesting for a client to invest in a AA credit exposure in the end if they can do that 100, 150 basis points over where the public bonds are trading.
I want to jump in though on that amortization point because that's really important to me. And I think in the public markets, trying to access data centers, a lot of what's come so far, certainly through the asset-backed market, has been non-amortizing. And not only is it non-amortizing, but it's also non-amortizing with step-up coupons in the event that a refinancing is not possible. And so I think that there are aspects of what's available in the public market for data centers that is somewhat inferior to what is starting to be negotiated and available in the private market. So one of the things that I really value in my role is being able to hear from Liz and Ravi about how they're viewing these asset classes so that we can think about the best way to access the asset as opposed to just having to take what the market's giving us.
And that's a really good point. I also think it's not just accessing the infrastructure and the underlying sort of assets, it's how do you access the companies as well, right? So the folks that work on our growth lending business, as an example, spend a lot of time investing in the most innovative companies that are going to need the data centers and the infrastructure, but you can get access to those companies in the private markets as they're inflecting and they're growing. But very similar, I think, Liz, to what you've outlined, really being able to tailor each loan and do the underwrite is what makes the difference as to whether or not you're repaid as a lender. And I think that's something we all probably share in common. So with that, I will say a huge thank you to Alyssa, to Ravi, and to Liz for taking the time today.